Hello and welcome to the show. This is actually part 3B of the MetaMaterials three-part series, where in part 3 we'll be talking about shareholders and the squeeze, whether it's a short or a gamma squeeze, and what shorts are, what gamma squeezes are, what they look like. In part 1 we talked about the Torchlight dividend and what the spin-off might be. In part 2, we talked about MetaMaterials, the company, and in part 3, part 3A at least, we talked about what short interest is, how much short interest there is, how it's reported, and what effect shorts have on prices. So in part 3B, we'll be talking about the options market and how the options market affects shorts and how shorts use the options market. Okay. So let me start off by saying I'm not a financial advisor. This is not financial advice. This information is intended for entertainment and educational purposes only. So, let's begin. So, what's a gamma squeeze? We'll start off by that. A gamma squeeze is something that starts in the options market. It ends in the physical stock markets. And it basically is a result of somebody buying a call option, which is the right to buy a share at a strike price. And there's a seller called a call writer, and the call writer is assuming risk. The risk he's assuming is that prices may rise to the strike price or above, in which case he will have to deliver those shares at the strike price to whoever bought the call option, right? So the call writer wants to hedge his risk by buying shares before it reaches that strike price, right? As it's heading towards that strike price, and he wants to limit his losses. He wants to limit his losses in the options market by buying shares in the stock market, and that's what comprises a gamma squeeze. So let's talk about this a little bit, okay? So a call option is the right, but not the obligation, to buy a stock at a strike price before a certain date, and we call that date the expiry date. So let's say there's a guy who wants to buy some call options, so he'll buy some calls and he'll buy them from the derivatives market. Okay. Now, if the price goes higher than the strike price before the expiry date, then that call option has value. And it's called an in-the-money call. It's called in the money, right? If it doesn't, if both of those criteria are not met, right, then the call option has zero value and it's out of the money, right? So if it's within the strike, if it's at the strike price, if the price of the underlying stock is higher than the strike price, then that call option has value. Okay. So let's look at what calls look like, right? So if we look at calls, we see these are call options, right? And this is what's called a straddle view of the options market. Here we can see what the strike price is. The strike price is in the middle. We have strike prices of $1, $2, $3, $4 for MetaMaterials, right? And we also have the expiry date. This is a January 21, 2022 expiry date. So this is when the options will actually, expire. So if the price goes higher than the strike price, right, then, and it's before the expiry date, then that option has value, and it's called in the money. So if we look, we can see that the current price of the underlying share right now is $2.58. And if we look at strike prices of $1 and $2, we see that that the current price is higher than the strike price. So those particular calls, those particular options, are called in-the-money options. Okay, and the open interest, if we look at that line, that indicates how many calls have been created and sold. So what's shaded in blue is the in-the-money. And what's not shaded is called out of the money. And these out of the money options have zero value, right? And if you look at the price of the out-of-the-money options, you'll see that the price is very, very low. It's like 5 cents or so. If you look at the prices of the call options that are in the money, you'll see that they have value and that they have a much, much higher price. So those are calls, and they're basically bets on the future price of the stock and not the actual stock itself, right? So they're bets on what the price of the stock will be before the expiry date. So because you're not trading in the actual stock itself, these are called derivatives. So this is known as the derivatives market because it's derived from an underlying share. Okay. So the derivatives market itself, if you were to actually look at the derivatives market, it's actually much, much bigger than the stock market. In fact, it's many, many times larger than the stock market. People placing bets on the price of a stock are much higher than the actual stock itself. Okay. Now, on the other side of calls, the opposite of call is what's called a put option. The puts are on the right side. And that's the right, but not the obligation to sell a stock at a strike price before a particular expiry date, right? So, so if the price is lower than the strike price and it's before the expiry date, then that put option has value and it's called in the money. Okay. So here we see the stock price is $2.58. So for strike prices of $3, right? Those puts, for strike prices of $3 and above, those puts have value. And they're in the money, and they're shaded. They're in the blue shade here, right? And the white, the unshaded puts, they have no value. They're called out of the money. So that's how the options market works. Okay. So how do shorts use the options market? Well, so this is how a short and distort play actually works in real life. So you've got Mr. Short. He first buys puts, and he buys them from the derivatives market. This is before he's done anything else. He buys a whole bunch of puts. He's going to pre-bet that the price will go down. Then Mr. Short will naked sell short shares directly into the market to a whole bunch of buyers. There are people who want to buy the stock at the lowest possible price they can, and Mr. Short will just sell them shares at the at whatever the market will bear, right? He'll say, you're willing to buy shares at below market price, I'll sell them to you. And he naked sells those shares. He doesn't own those shares at all. He just sells them. So now he's got a liability. And what he does is he sells the shares directly into the market. So he's naked short sold those shares, and then he spreads FUD, fear, uncertainty, and doubt. He spreads rumors. He might spread at, something called a short report or something. And he tries to let people know that the underlying stock has no value, and he tries to drive the price of the stock down. And then he makes his money from the put contracts that he's previously bought, right? Those put contracts have now, they may have been out of the money, and now they're in the money because he's driven the share price down. And then, once he's made money from the put contracts, then he'll borrow the shares back from, anyone who can loan him the shares, right? And if he's unable to borrow those shares, he triggers what's called a failure to deliver, right? And a failure to deliver occurs when he can't find any shares anywhere to borrow from, right? He can't say that, hey, look, he's found shares. And that means that those shares have been sold naked into the market, right? So then he repeats, and he does this continually over and over and over again until he can drive the share price down to zero. So that's how short and distort works, right? He basically buys puts, sells them into the market, spreads FUD, rumors, drives the share price down, makes the money from the put contracts, and he borrows the shares from some person who already owns the shares and pays the borrow fee. And if he can't find the shares to borrow, he triggers what's known as a failure to deliver. Okay? And that's how short and distort works. And he keeps doing that forever and ever until the price goes down to zero. That's his goal. So we can see, interestingly enough, what the failure to delivers look like on a chart. look like, because they are reported. Now, they're reported not that often, but they are reported. And the SEC has a report. This is a failure to deliver chart from the United States SEC for MetaMaterials. And if we look, it doesn't go back that far, but if we look around the June 30th time frame or June 20th time frame, June 29th time frame, there are a large number of failures to deliver. And that basically indicates, it can be an indication that there is a large number of naked shorts out there, right? Large number of people shorting the stock, and they can't find the stock to borrow from anywhere. And they have basically sold stock that doesn't exist into the market. And anytime you see a large spike in the failures to deliver, you can see that the shorts are either trying to suppress the price, or that they are or trying to lower the price. Sometimes they succeed, like in the June 29th time frame, right, where they're able to short tremendously. Sometimes they're just able to limit the share price from increasing dramatically, right, by shorting into a rising market. And in that sense, they can contain the share price as much as they possibly can. So these are what the failures to deliver look like for MetaMaterials. Let's see. So again, in the June 29th time frame, we've got a successful short attack. In the end of August, early September time frame, we had a short attack that failed, but it did limit the upward price action. And we also saw that in the September time frame, there was another short attack that limited upward price movement. It kept the price just basically steady to downward. Okay. So what's a gamma squeeze? A gamma squeeze is something that starts in the options market and it ends in the physical market, right? And it's when a call writer, or wants to, they want to limit the risk that they see happening when the price of the stock is increasing, right? Because call writers assume risk that the prices may rise. And if the prices rise to the strike price or above, the call writer will have to pony up the shares. Now, he may or may not have the shares. If he has the shares, that's called a covered call. But if he doesn't have the shares, it's called a naked call. And he may want to limit that risk for naked calls by buying shares as the share price is rising, right? So he can limit his losses in the options market by buying shares in the actual physical stock market. That's what a gamma squeeze is. And how does that really work? All right, so you've got a call buyer. He thinks the price is going up, so he's going to buy some calls. So he has a right, but not the obligation. He doesn't actually have to exercise the call. He has a right, but not the obligation to buy a stock at the strike price before the expiry date, right? And if we see what the options look like here, we can see the options market, and we see that there's a call writer. And if you look at the current price of the shares, it's right between the in the money and out of the money calls, right? And that transition from shaded to being in the money to being out of the money, the unshaded, is where the current price is, right? So if the prices rise, that means that current price and the shaded region will be dropping. And as more and more shares now become in the money calls, the out of the money calls become in the money, right? So the unshaded areas become shaded, and so the out of the money calls become in the money. And when that happens, the call writers who may have out of the money calls, right, they're now seeing that they are liable to deliver shares which used to be out of the money. They used to be not worth anything. Now suddenly they're worth something, and they have to deliver those shares, right? So those call writers want to limit their risk. So what will they do? They'll basically they'll buy shares in the stock market, right? And as the price of the stock is increasing towards their strike price, they'll start buying more and more shares, right? And that's called a gamma squeeze, right? So call writers buying shares to limit their risk as the stock price is increasing will cause the stock price to increase even more. So it's a feedback mechanism, and it works onto itself. That's called a gamma squeeze. So And the gamma squeeze itself may cause something called a short squeeze, right? So shorts may suddenly find themselves, possibly getting margin calls, and they may find themselves getting squeezed. So a gamma squeeze can actually affect a short squeeze. So that brings up the question, what about a long time ago, there was a company called Torchlight before they merged. What about the Torchlight call options? The call options that were, because Torchlight doesn't exist anymore. It was bought by a company called MetaMaterials. If Torchlight doesn't exist anymore, what happened to those call options that were, way out in time? Well, it turns out the last Torchlight options chain expires on January 21st, 2022. And those Torchlight shares, because Torchlight doesn't exist anymore, those shares don't exist. Torchlight and MetaMaterials, they merged together into a new company called MetaMaterials, and if you were a Torchlight shareholder, you would get something called a Series A preferred shares. And those Series A preferred shares would allow you to access a dividend from the sale of oil and gas assets from the company. These Series A dividends were never meant to be traded, and that basically means that MetaMaterials did not spend any time or money to make those Series A shares tradable, right? So if you bought Torchlight call options, you now have a situation where Torchlight doesn't exist as a company, and instead you've got these Series A preferred shares. Okay. Now we know that in time that somebody else spent the time and money to make those Series A preferred shares tradable, right? And they were tradable as MMTLP, the MetaMaterials Torchlight preferred shares. They were tradable on the over-the-counter markets, and this was done by somebody else, not MetaMaterials, just so that they could actually buy those shares or that they could sell those shares. So somebody else spent the time and money to do that. And we're now in the situation where there is no more of the old MetaMaterials stock. There's only the new MetaMaterials stock. We don't yet have the dividend from the sale of the oil and gas assets because that has not been announced. We do know that there are these options from these Torchlight shares, which existed from a long time ago. And those options will result in getting Series A preferred shares, the MMTLP shares, and MetaMaterials shares, okay? If those options are exercised. Because the Torchlight shares became the Series A preferred shares plus MetaMaterials shares. So those options become MMAT1 options. That's what they were called at one point in time. And one MMAT option will result, because of the reverse split and how it works, it will result in 50 shares of MetaMaterials MMAT and 100 shares of MMTLP. Okay, so one contract of MMAT1 will result in the ability to exercise and obtain 50 shares of MMAT at the strike price and 100 shares of the MMTLP shares at that strike price, right? And that's what you would wind up getting. So if we look at the options chain, this is the Fidelity options chain. You can see that they have two options that expire in January 21st, 2022. This second option we can see, which appears, has a multiplier of 100, and its deliverable is 50 shares of MMAT and 100 shares of MMTLP, right? So, and it's got a strike price of 2.5. And those are the options that you can see as call options. That's what they would deliver. So these are the options that we're interested in. These are the Torchlight options. So they exist. And there's an open interest of about 3,078 of them in Fidelity. And they are in the money, right? There's also out of the money ones, but let's look at this in the money ones. $2.50 in the money. There's 3,078 contracts. Each contract is equal to 100 shares of MMTLP. So that represents That represents 300,000, about 308,000 shares of MMTLP is one contract, right? And it represents 50 shares of MMAT, right? So so there you go. Those options exist, and there's a large open interest of them at the $2.50 strike price. Now, interestingly enough, Torchlight doesn't exist anymore, but these options chains also end because there's no Canadian company called MetaMaterials. It's merged with the U.S. company called Torchlight, right? So the belief is that when an options chain ends, right, all the FTD positions, all the failure to delivery positions, must be closed out by T plus 35 days due to the final options expiry, right? There's this options chain. This is the end of the line. There's no more Torchlight. So MetaMaterials, so MMAT1 doesn't exist after January 21st, 2022. So that means that T plus 35, they have to close out the FTDs, which means a potential slew of buying at that point in time. So I didn't come up with this theory. This theory is making the rounds on Reddit. It goes by the title "Robot Strippers Riding Canadian Unicorns." So if you look that up on Reddit, you'll see that it's got a lot of posts, it's got a lot of hits, it's got a lot of upvotes. People are talking about it. They're talking about how to buy those options, what those options might mean, what the failure to delivers mean, and they're saying that this may happen because of all of these Torchlight shares. The options chain is expiring, and the FTDs need to be covered at that point. So, and this is being passed around to multiple boards. This particular board is the what is it? This is a Small Street Bets board, and it has something like 300,000 users or something like that. So there's a large number of people who might be believing in it. It's got a large number of upvotes. So again, so there's a lot of possibilities here. There's another theory that's going on, and that's about the Oil Co. Right, Oil Co. company. So on December 3rd, there was an update about the Series A preferred shares stock dividend from MetaMaterials, and if we look at the update, in the third paragraph or so, they say completion of the work will, the company believes, enable us to move to the next steps in the spin-out process for the assets. This work includes, but is not limited to, formal transfer of the assets to Oil Co. Holdings, a newly formed wholly owned subsidiary of Meta. And then they talk about Oil Co. Holdings, and what the capital structure would be. Okay. So the way the theory goes is that we learned about the Oil Co. shares, and it's possible that that MetaMaterials will do a spin out, which would result in a delivery of the Oil Co. shares. Now, the only place you can get the Oil Co. shares from is MetaMaterials, right? So that means that there would have to be a scramble by shorts to obtain the Oil Co. shares. And they have to be delivered, right? They have no choice but to deliver them. So whoever sold the MMTLP shares, they'll have to deliver these Oil Co. shares now, right? And these Oil Co. shares could then, later on, supply a cash dividend from the sale of the oil and gas assets, right? And so that's another thing that the shorts have to deliver on. So they have to deliver the Oil Co. shares, which they don't have, and then they have to deliver the possible cash dividend that comes from them. So that's another possibility of a squeeze about about how Oil Co. could be, an intermediate step. And there's another theory that's going around. It's called the Domino Theory, right? So the Domino Theory says that there's a ton of short hedge funds out there. And when one short hedge fund closes its short position, it's going to do a bunch of buys, and that's what closes the actual short position. And the buys from that closing of the short position will cause the price to increase. And the increase in price will cause another short hedge fund to close its short position, right? So and it gets triggered all over again, right? And finally, there's what I call the external factors theory, right? And that says that, hey, look, you don't even have to have the share price increasing to cause a potential squeeze, right? If you're a short hedge fund and you own a whole bunch of shares of other things, if the other things that you own drop in price significantly, like let's say you owned, I don't know, Evergrande bonds, or you owned mortgage-backed securities, right? And those dropped in price significantly, that could cause a liquidity crisis. And that would mean that the short hedge funds would have to close their short positions in either MetaMaterials or MetaMaterials Torchlight preferred shares, the MMTLP shares. And that buying from closing of the position will result in increasing the price. And that price increase will mean that another short hedge fund has to close its short position. And it goes on and on and on. That's the external factors theory. So as you can see, there's a lot of ways that shorts might wind up having to cover. And it's likely that there's a lot more short interest out there than the official 30 million shares that are disclosed. Don't forget that that was a disclosure that took place over 15 days ago. The shorts might be forced to deliver shares that they don't have, like shares of Oilco, right? And that can result in a significant price increase in the shares that they need to deliver that they don't have. And on top of that, you might get a cash dividend even after that. And that would be another liability for the shorts, right? So if those things happen, you could get a huge short squeeze potentially. The other thing is that, hey, look, if you're gonna get an MMTLP dividend, a lot of people might reinvest that MMTLP dividend into MetaMaterials, right? And if that happens, that could result in a price increase in MetaMaterials. And that price increase could be a significant liability to anyone who's short MetaMaterials, right? So as a result, there's a whole bunch of ways that the shorts can get, squeezed and wind up having to pay for increasing share prices significantly, right? And as a result of all of these different ways that they could get squeezed, it's possible that the shorts aren't even able to exit their position without triggering either a short squeeze or a gamma squeeze. And if that's the case, they are truly stuck, and there's nowhere for them to go. And that ends part 3. So we talked about who owns the shares in part 3A, what a possible short squeeze might look like in part 3B, and possible catalysts for that. So let me end this presentation by saying I'm not a financial advisor. This is not financial advice, and this information is intended for entertainment and educational purposes only. Goodbye.